Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, November 13th. The US dollar rally is gaining momentum across the board, with the US dollar index hitting its highest level since spring, as the Federal Reserve does continue to trim their rate cut expectations amid rising inflation risk from the Trump policies. Now, the US will be releasing its latest CPI update today. It's obviously and clearly too early for the data to reflect the impact of Trump's re-election, but the mere fact that he is returning to the White House will restore significance to the upcoming inflation data. So the US yields pushed higher and the US dollar rally gained further momentum yesterday as investors continued to surf on the idea that Donald Trump's pro-growth policies and tariffs would boost inflation in the US and will hence limit the Federal Reserve's capacity to ease the monetary policy in the US as much as previously anticipated. And yesterday's economic data showed an improved economic optimism in the US for November. As such, the US two-year yield, which best captures the interest rate expectations from the Fed, is up by 85 basis points since the September dip. And we could actually see a similar jump in the US 10-year yield. And looking at the Fed members, the Minneapolis Fed President, Mr. Neel Kashkari, said that, he will be looking at the inflation data to decide whether he would back another interest rate cut in December or not. And finally, activity on Fed funds futures gives no more than 62% chance for another 25 basis point cut from the Fed in December before the release of the latest US CPI update that is due later in today's trading session. So, as you understood, the CPI data has regained all of its importance since Donald Trump was re-elected the president of the United States. Now, obviously, the jobs data remains crucial for the Federal Reserve's monetary policy path, as the last thing that the Fed members want is to panic and to lose control of the situation. But the Fed's victory over inflation looks much more vulnerable today than it did a month ago. And that's obviously supportive of the US dollar in the medium run. This being said, the October figures won't tell much about the Trump effect on the US consumer prices, obviously, not just yet. We must wait a few more months before we start seeing the real impact of Trump on these numbers. But the higher the numbers, the lower the December rate cut expectations. And I personally sense that the numbers today may not soothe the Federal Reserve those nerves, as the headline inflation in the US is now expected to have climbed from 2.4 to 2.6%. While core inflation in the US is seen steady near the 3.3% level, which is still significantly above the Fed's 2% policy target. Any upside pressure in these figures should continue to drive capital into the US dollar, but the US dollar has hit the overbought market conditions following a 6% rebound since the beginning of October. Therefore, any weakness or any data in line with expectations could eventually help tame demand in the US dollar in the very short run, trigger a minor downside correction, and give the US dollar bulls opportunity to strengthen their bullish positions for the end of this year. So the outlook remains positive, guys. Looking at the major currencies, the euro dollar tipped a toe below the 106 level at yesterday's trading session, while also weakened by soft ZUI data from Germany and from the Eurozone. Then the dollar yen traded a few pips below the 155 level, as the pound saw an accelerated sell-off below its 200-day moving average and hit the 1.2720 mark. Now, of course, the US dollar's strength will obviously hit several speed bumps in the future, and the initial rally will probably continue, but continue at a lower speed because the US dollar's appreciation, as we see it today, and other currencies' depreciation against the US dollar will boost inflation expectations in the rest of the world as well, and that would lead to a slower than otherwise monetary policy easing from the other central banks around the world. But the US dollar outlook is comfortably bullish at the moment, as I said before, and there is room for a further retreat in dovish Fed expectations for December and moving forward. And voices calling for a further slide off the euro dollar toward parity are growing, just saying. But if it's any comfort, the energy prices don't look threatening for inflation, and it is a good thing. So the barrel of US crude is testing the $68 per barrel support to the downside on sluggish Chinese and global demand, ample supply from non-OPEC countries, and also the absence of fresh geopolitical tensions from the Middle East. And add to that the fact that OPEC actually cut its oil demand forecast for fourth consecutive month yesterday, and you obviously have a very comfortably bearish picture for oil prices. In numbers, well, OPEC now expects the global oil consumption to increase by 1.8 million barrels per day in 2024, and that's just under 2%, and that's around 107,000 barrels less per day than previously estimated. And you know what? It's more optimistic than many bank forecasts on Wall Street, and it's more optimistic than Aramco's own forecast, and roughly double of the IEA's estimation of oil demand growth. So the latter will release their latest report on Thursday, but for now, and under these current circumstances, the oil bears keep the market in their hands. Trend and momentum indicators remain comfortably bearish. The RSI indicator isn't close to overbought market conditions, meaning that there is still room for the sell-off to extend in the short run. And the $70 to $71 per barrel range that shelters the minor 23.6% Fibonacci retracement level and the 50-day moving average is crowded with offers. So the major upside risk here, besides the geopolitical risk, of course, is another delay to the end of the OPEC production restriction plans. I mean, I actually see that coming big as a mountain now. But that decision will certainly not come before the 1st of December at OPEC's next scheduled meeting, unless we see an accelerated meltdown in crude oil prices that would eventually necessitate an early announcement from the OPEC countries then the 1st of December. For now, price rallies are interesting top-selling opportunities because, again, solid resistance is seen into the $70 to $71 per barrel range, and the key resistance to the actual negative trend stands at the $72.85 per barrel level, which is the major 38.2% Fibonacci retracement on the summer to now sell-off. Now, the downside pressure in oil prices weighs on oil company valuations, but the downside in oil companies' share prices remains limited by optimism that, well, Donald Trump loves these big oil companies and he will want them to pump and sell as much as possible to lower the energy prices. So Exxon, for example, is trading near the $120 per share level, which is a few dollars below an all-time high level, defying the weaker oil prices. But note that even though oil giants are happy to see oil-friendly Donald Trump take the reins off the US, they actually prefer price over volume, and Exxon CEO even said that Donald Trump shouldn't bail on the Paris climate deal and doesn't see a big near-term boost in US oil output. But long the oil companies is part of the Trump trade, and the shift from ESG and clean funds to traditional fossil fuel energies should give oil giants, well, some room to breathe, at least for the next few years under Trump presidency. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.